Most finance leaders think about SaaS purchasing as a budget event. The money is there, the requirement is approved. You go to the vendor, you negotiate. Wrong sequence. The single biggest lever in any SaaS negotiation isn't your negotiating skill. It isn't even your budget. It's timing. Specifically, understanding where your vendor is in their own financial story. In this episode, I'm going to give you the vendor intelligence framework I use before signing any enterprise software contract. It covers three things: the vendor's growth stage, their fiscal calendar, and their investor dynamics. Each one of these, used correctly, is worth tens of thousands of dollars off your next renewal. Let's get into it. Before I tell you when to buy, you need to understand what your vendor is optimizing for, because that changes everything about what they'll negotiate. Every SaaS company is measured against three core metrics, and the weight of each one shifts dramatically depending on where they are in their growth cycle. The first is ARR, annual recurring revenue. ARR is the total value of active contracts on an annualized basis. If a vendor has 1,000 customers each paying $10,000 per year, their ARR is $10 million. ARR is the North Star metric for early-stage SaaS. It tells investors how fast the business is growing. The second is EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a measure of operating profitability. Mature, capital-efficient SaaS companies are measured on EBITDA. It signals that growth is sustainable and the business can run without constant external funding. The third is the Rule of 40. The Rule of 40 is a benchmark used by SaaS investors. The sum of a company's ARR growth rate plus its EBITDA margin should equal or exceed 40%. A company growing ARR at 30% with a 15% EBITDA margin scores 45, healthy. This rule signals overall business quality to investors. Now here's why this matters for procurement. Think of a vendor's life cycle as a curve with four distinct phases. In the earliest phase, seed through Series B, ARR growth dominates everything. Investors want to see the business scaling fast. In the growth phase, Series C and D, the Rule of 40 becomes the benchmark. The vendor needs to show both growth and improving efficiency. In the late stage, pre-IPO or private equity-backed, EBITDA starts to matter alongside ARR. The profitability story needs to be credible. And in maturity, most public enterprise SaaS companies, EBITDA is primary. ARR still grows, but organically at 3 to 5%. The business is optimizing for profit, not hypergrowth. Each of these phases creates different negotiating dynamics for you. Let me give you the most powerful one. If your vendor is in early stage, Series A or B, growing ARR aggressively, probably not yet profitable, here's what's happening inside their board meetings. Their investors are watching ARR growth above everything else. A multi-year contract from an enterprise customer is extraordinarily valuable to them. Not just for the revenue, but because it signals to the next investor that they can win and retain enterprise clients. Which means, if you're willing to sign a 3-year contract, you have significant negotiating room. We're talking 20 to 35% discounts in some cases. Not because the vendor wants to give money away, but because locking in ARR for 3 years is more valuable to them than extracting the last percentage point on year 1. However, and this is critical, there is an important condition. If you ask for termination for convenience, meaning the right to exit the contract at any time for any reason, you destroy the ARR accounting benefit for the vendor. Under standard revenue recognition rules, a vendor can only recognize multi-year ARR if the contract is not freely cancelable. The moment you insert termination on convenience, they can't count the full 3 years as committed revenue. The accounting treatment collapses to month. And so does your negotiating leverage. The exit clauses that don't destroy ARR accounting are specific: data breach by the vendor, insolvency, or material breach of contract terms. Those are legitimate protections that sophisticated procurement teams always include. and vendors will agree to them. What you cannot have if you want early-stage pricing is an open door out. Fair trade. Make sure your internal stakeholders understand this before you commit. And here is a question worth sitting with. Do you actually know what growth stage your key SaaS vendors are at right now? If you can't answer that, this episode is your action item. Most procurement teams buy on their own budget cycle. The money unlocks in January. They start the vendor conversation in February. The problem is that February, for most US SaaS vendors, is the beginning of their fiscal year. Their sales teams have fresh quotas, their finance teams are optimistic, and their motivation to offer discounts is at its annual low. The highest pressure moments for a SaaS vendor are predictable, and predictability is what makes them exploitable, in a legitimate way. Not all periods carry equal weight. Here is the hierarchy of pressure for most SaaS vendors. Year-end close is the highest pressure moment. Annual targets, board expectations, investor sentiment all land at once. This is when the most significant discounts become available. Half-year close is the second most important. The first half number sets the narrative for the full year. If growth is behind budget, the pressure to make the second half look strong is intense. Quarter end is real, but less powerful than most buyers assume. Reps need to hit quarterly numbers, but quarterly discount authority is usually lower than year-end authority. The two most common fiscal calendars in enterprise SaaS are January to December and February to January. The February start is common among US vendors who wanted to avoid December noise. Knowing your vendor's fiscal year is 10 minutes of research. Check their investor relations page, their LinkedIn company page, or simply ask your account manager. They will tell you. Now, once you know the calendar, the next lever is monitoring performance against budget. If your vendor is a public company, their quarterly earnings calls are publicly available. If they're private but VC-backed, you can often track ARR signals through press releases, LinkedIn announcements, and industry news. When a vendor's growth is behind plan, and you have visibility on that, the negotiating dynamic shifts significantly. A vendor showing ARR growth of 15% against a 25% target is under real pressure. Their sales team is behind. Their investors are asking questions. That is precisely the moment to initiate a renewal conversation or to negotiate a new module at a rate that would have been impossible 3 months earlier. Increasing ARR, even through a price-sensitive deal, is still growth. Vendors in pressure situations will often prioritize keeping ARR, moving over protecting short-term margin, especially if the alternative is losing you entirely. And here is something worth asking your team. Does your procurement function have a process for monitoring your top 10 vendors' financial performance, even at a basic level? If not, you're negotiating blind. Here's something that almost no procurement guide will tell you. When a venture capital or private equity investor is preparing to exit a SaaS company, whether through a secondary sale, a recapitalization, or ahead of an IPO, they want to maximize the valuation at which they sell their stake. And in SaaS, valuation is almost always a multiple of ARR, which means an investor preparing to exit has a strong incentive to see ARR grow, or at minimum stay stable in the months before their exit, even if that means the company accepts a lower margin deal to retain a customer or win a new one. So if you know that one of your vendor's major investors is preparing to exit, through secondary market signals, press coverage, or simple LinkedIn monitoring of investor activity, you have additional leverage that most buyers never think to use. In an early-stage company where ARR is the primary metric, an exiting investor may create internal pressure to show strong growth numbers. That pressure can translate directly into an additional few percentage points of discount, because your ARR counts toward the valuation they're trying to protect. Now, I want to talk about the most powerful and most dangerous negotiating lever in SaaS procurement: churn, the failure to renew a contract. For a SaaS vendor, losing a customer is significantly worse than reducing the price for that customer. Customer acquisition costs are high. The lost ARR appears on their dashboard immediately. And for VC-backed companies, churn spooks investors. If you're prepared to play this card, and I want to be very clear, you should only do this if you are genuinely prepared to follow through. The mechanics work as follows. There are 3 conditions that make this tactic viable. First, you represent a significant percentage of the vendor's global ARR. This is most powerful for regional or niche vendors where you are one of their top 20 customers. Second, your logo has high brand recognition in the vendor's target market. If they use your company's name in their sales materials, losing your logo means losing a sales asset, not just revenue. Third, the vendor has recently lost another large customer. This amplifies the ARR sensitivity and makes churn from a second major account genuinely alarming from an investor relations perspective. Under these conditions, sending a formal non-renewal notice or even a letter of intent to terminate can produce extraordinary results. Vendors have been known to offer discounts of 30, 40, even 50% to retain a strategically important customer. But I need to say this clearly. If you are not genuinely prepared to leave, do not use this tactic. SaaS procurement is a long game. If you make a threat you don't follow through on, you signal weakness. And you will pay for that in every future negotiation with that vendor. A question worth sitting with. Do you know what percentage of your top 5 vendors' global ARR your contract represents? That number determines how much of this leverage you actually have. Whether you're in a 3-year deal with an early-stage vendor or a 1-year renewal with a mature platform, there are 4 contract terms that always belong in your negotiation. The first is a flat renewal rate. This means the price stays the same for the entire contract term. No annual escalation. I covered price escalation clauses in depth in episode 1. The short version, a 5% annual escalator compounds to 15% above year 1 pricing over 3 years. Negotiate a price cap at signature. The second is a right-sizing clause. This gives you the right to reduce your seat count or active modules by 10 to 15% per year without penalty. When you commit to 3 years, you cannot predict headcount changes, business restructuring, or product strategy shifts. This clause is your safety valve, and most vendors will agree to it if you ask at the time of signature. The third is a set of appropriate exit clauses. As I mentioned earlier, the right to terminate for data breach by the vendor, insolvency, or material breach of contract. These protect you without destroying the vendor's ARR accounting. Every enterprise deal should contain these as a minimum. The fourth is data portability. The right to export all your data in a usable format at any time, not just at contract end. Without this, switching vendors becomes prohibitively expensive. It is your exit cost insurance. A question for you. Go and look at your 3 largest SaaS contracts right now. Do they contain a right-sizing clause? If not, put it on the agenda for the next renewal. Let me pull this together. Most SaaS procurement happens at the wrong time, with the wrong framing, and without the vendor intelligence that changes the outcome. The vendors who sell you software are not neutral counterparties. They have financial pressures, investor expectations, growth targets, and quarterly deadlines. They have ARR they need to protect, board meetings they need to prepare for, and investors they may be trying to satisfy. Every one of those pressures is information you can use, if you know how to read it. Understand what stage your vendor is at. Align your renewal conversations to their fiscal pressure points. Know your position in their ARR portfolio, and make sure your contracts contain the terms that protect you for the full duration. That is the difference between a procurement team that manages software contracts and one that actively optimizes them. If you want to go deeper, the free CFO Procurement Toolkit covers vendor scoring, TCO calculation, and renewal checklists. Everything in one place. Link is in the description. Next week, SaaS pricing models and why the wrong one will cost you. Subscribe if that's useful. See you next week.